But for me, that's exactly the time that you should be taking the trade. In other words, it doesn't look as nice a trade, it doesn't feel right, and in my experience, those are the trades that win for me.
Two traders, Darren and Walter, pull back the curtain on profitable trading systems, consistent money management, and profitable psychological triggers. Welcome to the Two Traders Podcast.
Welcome back to the Two Traders Podcast. I've got Darren on the line. How are you going today, Darren?
I'm pretty good, Walter.
So we're going to talk about space, Darren. And first of all, let's start with this. I know a lot of traders like myself like to trade reversals. So they like to find turning points. And I know that you do a lot of that too, or some of that anyway. And so, and it doesn't really matter if you're talking about a reversal point inside of a trend or just a straight up, this is where the market's going to turn around here and go away from this spot. A lot of traders like to hang their hat on, the fact that, hey, look, I found that spot on the chart where it reversed, and they like to feel like they're getting in on a reversal. For whatever reason, it's easier for most traders that I've come across to find reversal trades than it is for them to kind of jump in with the trend. Even if you're trying to trick yourself and saying, I'm getting this reversal where the market's going counter trend here, and then I get in on this reversal, even if it is in the midst of a strong trend. So one of the things I look at is what we call space or room to the left. And we don't know when there's a turning point on the chart, but we know that they have certain characteristics. And one of them is that they have space or room to the left, which is where the market's recently printed an area on the chart where it hasn't been there for a while, right? And it's starting to roll over and turn away from that area. It doesn't matter if it's making a little valley or a little peak, but this is something that I look for in terms of highlighting a possible turning point trade, a reversal trade. My question for you is, Darren, how do you view space, or do you even use it when you are looking at finding these exact same sort of places on the chart? Again, it doesn't really matter if it's a reversal within a trend, like a little retracement, and you're getting in on the reversal of the retracement, or if it's just a turning point on the chart, How do you use space, or is that something that even is used in your analysis?
Well, I don't use it myself personally because I tend to sort of take the approach of trading all of the reversals, and hopefully price will have to move away from that point at some point. And that's where I make my profit. And obviously, sometimes it doesn't always go my way, and sometimes I'm just paying for the losses I made from the failed reversals. But the thing that jumps out at me initially about it is when you look at the charts, those reversals where price hasn't been anymore, hasn't been for a long time, visually they look more appealing, and I imagine that reinforces people's belief in using something like that. But obviously, if you look at the human side of it as well, if price hasn't been at that level for a long time, then the people that, let's say we're looking at a reversal from the high, the people that have been buying will obviously also be looking at it and feeling that perhaps it's a bit extended and they want to take profit or cover their profits, etc. So I imagine fear will be creeping into the people buying, and the people who are looking to sell, obviously to them it looks attractive because we're at a high, and visually it will stand out because it's sticking out the top of everything. So whether there's a statistical advantage in trading them or not, I always sit on the fence with those sort of things, and I think if you tested it thoroughly enough, then there probably might be a small advantage in it. But I imagine, when you scan a chart, those areas, when you look back over price, look really attractive, and I think your mind may just kind of discount the areas where it was also doing that, but it didn't turn around, and you'll kind of focus on the ones that worked out and kind of discount the ones where it didn't quite work out.
Yeah, sure. That's a hindsight bias or a confirmation bias that we could be using. So, okay, so let me get this straight. So let's say that you saw a chart where there was a swing high. Let's say there was a swing high at, let's say we're talking about the euro, and I don't know, there was a swing high at 1.20. And then it turned around and started going lower. And then it made a swing low where it turned around and started going higher at 115, right? and then it came back up to 118 and made another swing high, right? So that 118 swing high, and let's say the first swing high at 120, like it hadn't been there in a long time, so it would be what we would call space. It'd have room to left. So the 118 is actually just as valid to you as the 120. Then you just take them all, as long as it's bending on the chart, you're in it.
Yeah, 100%. To me, there is no difference because, let's be honest, everyone looking at that chart is going to, well, not everyone, a large percentage of the people looking at that chart will be discounting the chances of it going short there because it hasn't, like you say, made a new high. Okay, so, but for me, that's exactly the time that you should be taking the trade. In other words, it doesn't look as nice a trade, it doesn't feel right, and in my experience, those are the trades that win for me. So I don't rely on my feelings to lead me correctly when it comes to trading. So, for me, that would be, just as valid a point to sell.
Yeah, right. And so then if it came back down and made a swing low at, say, 114, so we're 100 pips higher than the previous swing low at 115. So now it's tightening up. It's making higher lows and lower highs, right? So it's starting to constrict here. You would still take that high, like that swing low would be a potential buy then, right? Is that right?
Exactly. If the market turns around and breaks out, then I take the trade, and I don't really look at what's happened in the past. But, I want to be really clear that doesn't mean doing some analysis on how price is moving cannot be something you can use really successfully. The important thing for me is I think it's really difficult for people to do that, then execute a trade, then manage the trade, and then exit it. So, I just try and discount all of as much information as I can, just leaving me with a simple call that I can execute well. And also, if my trade doesn't work out, if I'd done a lot of analysis and, a particular technique for analysing the market that I'd worked on and, I was starting to feel confident about, if the trade doesn't work out, your gut instinct is going to be to blame yourself because you must have made some mistake with your analysis. And quite often what you'll do is you'll look at what's happened after you took the trade and say, with a bit of hindsight bias, you'll say, okay, well, it didn't quite fit my criteria. And you'll start making excuses. Whereas, I like to say, the market decides at the end of the day. Really, the best I can do is just execute my plan and only step out of that when the market does something really out of the ordinary. So, my reason for not liking that is really because I think humans find it difficult to do that. And I suppose that must be true because a lot of people trade using technical analysis and they find it very difficult to do. But I just want to stress it's not because I don't think it doesn't work.
Right, yeah. Well, a lot of people probably would say that fundamental analysis is quite popular too. And I don't know how they go with that either. They're gonna be lowering, the Reserve Bank of Australia is gonna be lowering rates over the next couple of years, so we're just gonna sell the Aussie, and the Aussie takes off. Yeah.
Can I just ask you? So, to be clear, the reason that you like to use this idea of space is because of human behaviour and because you think the fact that it's kind of trading at new levels means that the sellers are going to have this feeling that they want to cover their profits or take profit and that it's a good value place to buy, or is there something else going on in your head with that?
Yeah, great question. So really for me it always comes down to two things, and space would be like further on down the list. But the most important thing is that if I've got a place on the chart where it looks like to me, and everyone's going to look at it differently, but if it looks like to me that price is repeatedly reversed, Okay. So for example, if you look on the euro, 119, around 119, 119.30, that's a spot where the euro has historically found support and resistance. And everyone can go back on your chart and decide for yourself. Somewhere around 119, 119.30 is usually a spot that people will identify. So let's say that the euro hasn't been to 119. Let's say it's been above 119 for 5 or 6 years. And then all of a sudden it comes down to 119 and it prints what I would consider to be a reliable, viable reversal pattern at 119, then to me that's a really good spot to buy. It's more because it's on the support and resistance level and it hasn't been there for a long time. And so that's what space defines for you, is that it hasn't been there in a long time, right? So it's kind of like, and here's why I say this, because I would challenge anyone who's listening to this to try and find these spots, okay? Try and go through your charts and try and find a spot where the market has repeatedly, consistently hit a level over and over and over again. Doesn't matter if it's the bottom or the top, right? And it's hit it over and over again. So when I say over and over again, I mean if you're looking at, say, 10 to 20 candles, half of those candles or 40% of those candles are hitting that level, right? Those spots are generally not reversals. So if you can draw a box around some price action on your chart, those spots are usually not a spot where the market goes there and then doesn't come back for a long time. Usually that's a consolidation, what we call consolidation, and usually that's just the market's going to keep going from there, right? That's not the high or the low. In other words, the market generally, in my opinion, doesn't hit a high 10 out of 20 candles and then go away from there and not come back there for 6, 12, 18, 24 months. That's a rare thing to happen, okay? Now contrast that to what we're talking about here, which is like a really sharp probe into the, and when I say sharp, I mean 1 or 2 candles hit it and then it immediately turns around from there. It doesn't matter if it's a top or a bottom, but it hits there and then it quickly goes away. And the candles don't come back and hit it. It could be a double top or a double bottom, but it's not where it hits it 15 times. You know what I mean? Yeah, and so that's all I'm saying. And your point about seeing these only when they work out is absolutely true. Like if you go back and scroll back on the charts, you'll say, "Oh wow, this happens every single time." But what you don't see are those times when the market hits that level, sharply turns around, and then later on blasts through the level and keeps going. Right? That's definitely the case.
Yeah, your mind kind of paints over those, and you don't even know you're doing it.
Yeah, that's right. You skip right over those. That's absolutely right. So just because it's printed a reversal on a zone with space doesn't mean that it's going to go 700 or 1,000 pips away from that area. Sometimes it might only go 100 pips or 200 pips or whatever, and then it reverses and keeps going. In other words, it's in a trend, and that was just a pullback in the trend, So you don't know what's going to happen. You just don't know. But all I am saying is if someone puts a gun to my head and they say, "Hey, Walter, now look, you got to find a reversal on the chart." If I had to broadly define what was more likely to be a reversal, whether it's a sharp probing reversal like we're talking about, these sharp bounces with space, versus a consolidation box where it hits that level over and over again, between 40 to 50% of the candles are hitting it, I'm always going to go with that sharp reversal that has space rather than that consolidating box, because I believe that my testing and my trading has shown that those consolidating boxes are more likely to be just the market's going to eventually blow through there and keep going. And it's not going to be the spot where the market ultimately finds the bottom. So everyone has to do your own testing, and everyone will have to see, you got to see for yourself on the charts. But I guess that's the big deal to me, is that it's the pattern plus the spot on the chart, and then the space only just kind of adds to that and says, okay, well, yeah, this is in other words, this is a really sharp thing. But you know what? It doesn't have to be that complicated, guys. Like if you look at the line chart. And I'm guessing if I were to ask you, Darren, I'd say, okay, you've got a couple of reversals on the chart, or turning points on the chart, right? Fractal high or fractal low, whatever you want to call them. So you don't actually qualify them and say, well, this one's better than that one because the line chart shows a sharper turn. So if it's kind of rounded and slow to turn around, would that be any worse a signal than a really sharp one that has like a really strong angle? In other words, it was a candle up and then a candle strongly down would make that sharp angle. Whereas if you had a few candles that were kind of sitting there and they slowly rolled over, it would be more of a rounded peak high or peak low. So does that matter to you?
No, it makes no difference at all.
Right. Yeah, that's what I figured. Yeah, I figured you were going to say that. Yeah, I figured you were going to say that. So really, I guess one thing that I would want to ask is, there are advantages to, so if you trade like I do and you have these filters on, which are like, I think I can find a better spot to take a trade, so I won't take this one, versus you, where you say, look, I'm just going to take them all, and some of them are going to shake out. What would be some of the things, the mental hurdles that you'd have to overcome to trade the way that you do? I have some in the back of my mind right now, but I'm not sure if that's consistently, if you consistently see that with traders who do this. But like, so for example, when you trade like I do, some of the problems you would have would be you blame yourself, right? Because you go, oh, well, I had identified this as a really good signal or really good, and it didn't work out. So, maybe I got to change what I do, or maybe I blame myself for being an idiot, or whatever. I mean, people play these mind games, right? But when you trade like you do, where you kind of just letting it go, what would be some of the mental obstacles or difficulties that people would have to push through to consistently apply this strategy?
There's two main ones, I think. One is what we've learned already. Okay, so when you come to trading, you read books about trading. You go on forums, and you learn stuff, and obviously. The stuff that appeals to you initially will always kind of have like a bit of a lock in you. It'd be it's quite hard to start writing that off as good information. That's quite difficult, and usually that's associated with whoever's teaching it to you, saying it's simple. Look how well I'm doing. I'm making loads of money. So already you've bought into that information. It's very hard to take on anything that contradicts that. So that obviously is the first hurdle, and also that is teaching you that although most of the time that information has an add-on saying psychology is important, it's not kind of worded or put over in a way that it's equally as important as particular chart patterns or entry techniques or things like that. So that's one of the hardest things. And then going beyond that, once you get past that, and usually I find that most of the people who start to look at my style of trading have been through that for a long time. And really tried and not being able to get to grips with it or make progress. So now they're kind of thinking, well, I've got to try something different, because I can't go on like this. So that kind of helps deal with that. And the other one is accepting that you're going to make your money out of something that you have no control over at all. Essentially, my style of trading, it relies on what the market does this week. So if the market's choppy this week, you're going to lose money. If the market moves in a sustained swing, it could be up and down, but as long as it makes some sort of decent moves away from one price point to another, you're going to make money. And that seems great at first, but when you start, absorbing the fact that, let's say, you're looking to make your living out of trading, when you're trying to sort of give in to the notion that you've got no control over it, that's quite hard to take on when you're putting money on the line. I'm not saying, you can have an influence, because once you're in the trade, then you have to make judgment calls about when to take profit and when to manage your risk. But even with that, there's no definitive answer. You kind of have to wait and see what the market does, and then you have to make your best judgment call. Using techniques of, assessing yourself, looking at how you're feeling, looking at the market, a little bit of experience from before, from watching markets move. But, with all of it, there's a complete lack of control that you can nail down and rely on. And that is a really hard thing for a lot of people to do.
Well, that's all the time we have now for part 1 of Trading with Space. But in part 2, you will hear why being in control is dangerous for Forex traders. You'll also see why Darren doesn't care at all about missing out on the big market moves. And also, finally, how traders get paid by putting money behind insane ideas. All this and more in part 2 of Trading with Space.